Hi, I'm Michael Kelly. I'm the CEO of Parkview OZ REIT. Today we're going to be talking about qualified opportunity funds and what they are. The options for dealing with capital gains have changed dramatically in the last few years. The Tax Act of 2017 restricted the types of capital gains that could be deferred with 1031 exchanges, but it also created qualified opportunity funds, which can defer and partially eliminate any type of capital gain. So in this video, we're going to be discussing what you need to know to hang on to more of your money and to boost the after-tax returns for yourself and your clients. Some of the rules around qualified opportunity zone funds can be pretty quirky. So I think it helps to understand them if you know the backstory, what the original intent was of the Opportunity Zone Act and what it was trying to accomplish. It was originally the idea of Sean Parker, who was a founder of Napster and later president of Facebook. And he saw what we all see, which that there are some neighborhoods through all sorts of economic cycles. Nothing new seems to happen in them. They continue to have stubbornly high unemployment rates and low income rates. He wanted to figure out a way to get capital into these communities to jumpstart their economies. At the same time, he's in the middle of Silicon Valley. He's seeing founders of companies create great fortunes. Oftentimes, these founders would eventually leave the companies. They'd go on to do other things. They'd love to take the capital with them and start new ventures, but oftentimes they'd leave it with the company, and not because the company needed it. They're now successful Silicon Valley companies. They're surrounded by investment bankers, but they would leave it there because of the capital gain liability on it. As soon as they trigger that capital gain, their net worth would drop in California by more than a third. So it was what they call warehouse capital. It wasn't where it was needed. It wasn't where the owner of it wanted. It was just sort of trapped by this capital gain liability. So Parker set out to design a program that would mitigate the pain of realizing the capital gain on this, the original capital gain, and encourage the reinvestment of it into these communities that could really need it and to keep it there for the long term. So if you keep that idea in mind, it will make a lot more sense why this program just applies to capital gains and not other types of capital, and why a lot of the benefits are time sensitive and talk about creating new assets in these communities. So who is eligible to make an investment in a qualified opportunity fund and claim the tax incentives? Basically anyone who has a capital gain liability, a recent one, to the U.S. government. So you can be a U.S. citizen or not. You can be living here domestically, or you could be living abroad. You could be an individual, a partnership, a trust, a corporation, basically any person or entity that has a recent capital gain. And I say recent in that typically you need to reinvest your capital gain into a qualified opportunity fund within 180 days. But there are exceptions to that, so check on your individual situation. There are also a couple of benefits that qualified opportunity funds have over 1031 exchanges, if you're used to doing 1031 exchanges. The first is that you only need to reinvest the capital gain to defer and partially eliminate all the taxes, to get all the tax benefits. With a 1031 exchange, you have to reinvest the entire amount of proceeds that you have. So the capital gain, the principal, even if there's debt. With qualified opportunity funds, you only need to invest the capital gain, and only the capital gain portion will be considered good capital to get the tax benefits. The other nice feature is that qualified opportunity zone funds have no cash tracing. So with a 1031 exchange, you need to have the money never hit your bank account. The same dollars from the sale have to go into the new property, and most of the time you'll hire an intermediary to handle the cash to make sure that it's the same money. With qualified opportunity funds, there's none of that. They do not particularly care that it's the same dollars. They don't care that it's the same dollars. They only care that you have a capital gain and you're giving the money that represents that capital gain. So if you had a cashless capital gain, for example, you could take money from another, you could borrow money from a bank and put that into the qualified opportunity fund. And that would be considered good capital because you had this capital gain over here, even though it's not the same money. So specifically, what are the tax benefits for investing in a qualified opportunity fund? Well, there are three of them. The first two benefits go towards your original capital gain. So if you sold stock or a vacation house or whatever it is, and those are that you get to defer paying the capital gain. So you can defer it until you sell the qualified opportunity fund or until December 31st of 2026. So the tax will be due in the spring of 2027. The second benefit is that after holding the the Qualified Opportunity Fund for 5 years, you get to step up your cost basis by 10%. So that eliminates 10% of your capital gain liability. So the first two benefits are like the government giving you a 5-year loan on that tax liability with 10% principal forgiveness, which is attractive. But by far, the biggest benefit is the third benefit, which is that once you've held the Qualified Opportunity Fund for 10 years, you get to elect to step up your cost basis 100%. So that wipes out all capital gain liability. This is a long-term program. It goes all the way out to 2047. So you can compound growth in that vehicle, in the Qualified Opportunity Fund, for decades without any capital gain liability. It is truly a great way to create wealth. So what can Opportunity Zone funds invest in? Well, they have to invest in certified opportunity zones. So there are 8,700 plus of these around the country. They vary greatly. Some of them are urban and some of them are very rural. They typically have populations between 3,000 to 8,000. So in a city, there tend to be a neighborhood and they can be whole towns out in more rural areas. But they have very different economic characteristics. They are a wide variety. Some of them are already taking off and attracting a lot of investment and creating jobs, while others continue to stagnate. So there's a wide variety of types of areas that funds can invest in. There's also a wide variety of options for the types of assets they invest in. But there are two large categories. One is commercial real estate, which is what our fund does. The second is in operating businesses. So both of those are great ways to go. Commercial real estate's a lot easier because real estate stays put in the zone, whereas with operating businesses, it can be a little bit trickier to qualify because you may have salespeople and people, machinery and other things loaned out all over the place. So it can be a little bit trickier, but both can be very rewarding. The big thing is that they want new assets brought into the zone. They don't want you to just buy something that was already there. That's not considered a good asset. So, for instance, with commercial real estate, there are two ways to qualify a property as a good qualifying opportunity zone property. And the first is original use, which is that you build something new. So you buy a piece of land and put up a new building. That would certainly qualify. And the second one is substantial improvement. So with that, you need to improve the property by the value of the building on the land at the time that you bought it. So it doesn't include the cost of the land. So if you bought a piece of land for $3 million and the land was worth $2 million and the building on it was worth $1 million, you would have to invest another $1 million, a total of $4 million into that property to make it be a qualifying asset under the Opportunity Zone program. And you could do that by renovating the building itself. You could potentially build a second building on that site, do infrastructure improvements. They're pretty flexible about the way you improve the property, but as long as it helps the business and is helping the community along, that is going to be something that'll work in an opportunity zone. The second, an operating business, is a tremendous way to look as well, because an operating business, imagine if you started Google through a qualified opportunity fund. you would have a very large capital gain. So businesses, especially startup businesses, are looking at qualified opportunity funds as a great way to go and to be very tax efficient. With a business, you need to have 70% of the tangible assets be qualifying assets. And again, it can't be something that was already there. So it's easier to buy a business and move it into a zone. That way, all of the assets will qualify, rather than buying a business where you'd have to invest into it so that 70% of the assets were new assets. And there are some other restraints on businesses where you have to have, there's a few tests. You need to either have 50% of your income be coming from the opportunity zone, or have 50% of your hours worked, or there's a conjunctive test as well. But the bottom line is, if you keep in the spirit of the law, which is to help improve these communities, and you go by the basic guidelines, you're going to have a qualifying property. So hopefully this video gave you a basic overview of how qualified opportunity funds work and the benefits they provide. In the future, I'll be taking a deeper dive into other ways you can use qualified opportunity funds. We'll be talking about estate planning, art and collectibles, and also how to structure a qualified opportunity fund. So lots of topics to cover. I hope you subscribe to our channel, and I look forward to seeing you in future videos.